It is 2:17 in the morning. You know the exact time because you have been staring at the ceiling for the past 40 minutes and you checked your phone 3 times already. The house is completely silent except for the hum of the refrigerator downstairs and the occasional sound of a car passing on the street outside. You cannot sleep because tomorrow morning you have a meeting with your accountant and you have been dreading it for 3 weeks. Not because anything is obviously wrong, but because of a letter that arrived 11 days ago from the Canada Revenue Agency, a letter that used language you did not fully understand, but that contained 2 words in the subject line that have been living rent-free in your mind ever since. Compliance review. You pick up your phone again. But you open your Airbnb host dashboard for the 4th time this week, not to check bookings, but to look at the numbers, the way you look at a wound you are not sure is serious. 4 years of hosting, $47,200 in total earnings. You reported most of it. You think you reported most of it. You are no longer completely sure what you reported and what you missed, and whether the difference between those 2 numbers is the kind of difference that gets you a letter or the kind that gets you a court date. You set the phone face down on the nightstand. You stare at the ceiling again. You think about the fact that your home, the home you have owned for 7 years, the home you have been paying down slowly and carefully, and is sitting on an unrealized capital gain of nearly $600,000 that you have always assumed was protected. Tax-free. Yours. You are no longer sure it is yours, and the meeting is in 6 hours. Welcome back to Canada Property Watch. In recent weeks, we have exposed the deemed disposition tax that quietly seizes the inheritance your parents spent a lifetime building. We have documented the exit tax that strips the principal residence exemption from Canadians who thought they were selling their home tax-free. We have shown you the CRA's forensic audit catching income fraud that the banks missed for years. Today, we are going somewhere that affects a group of Canadians far larger than mortgage fraudsters or estate beneficiaries. We are going into the homes and bank accounts of the hundreds of thousands of people who used Airbnb, VRBO, and short-term rental platforms to survive the financial pressure of the pandemic years. And we are going to show you exactly how the CRA is using data it has already received from those platforms to reclassify your principal residence as a commercial asset and strip away the tax protection you have been counting on for years. To understand the scale of what is happening right now, you have to understand the context in which short-term rentals exploded across Canada. Between 2020 and 2023, listing your home on Airbnb became the financial survival strategy of choice for hundreds of thousands of Canadian homeowners. Mortgage payments were climbing. Inflation was consuming household budgets. The pandemic had normalized the idea of renting out space in ways that would have felt unusual 5 years earlier. Platforms made it effortless. You took photos, you wrote a description, you set a price, the bookings arrived, and every week money appeared in your account from strangers who slept in your basement, your spare room, or your entire house while you visited family or traveled for work. It felt harmless. It felt like a smart use of an asset you already owned. Nobody warned you about what you were actually doing to your tax position. Nobody explained what the word commercial means when the Canada Revenue Agency looks at a property that generated $47,000 from strangers sleeping in it over 4 consecutive years. But nobody sat across from you at the closing table when you bought the house and said that one day renting it out to tourists would be treated by the federal government as equivalent to operating a hotel. But that is exactly what the tax code says, and the CRA is now enforcing it with a precision and a reach that most Canadians never anticipated was possible. Let us build the profile of the person at the center of this investigation. Let us call her Jennifer. Jennifer is a 41-year-old teacher living in a 3-bedroom detached home in the east end of Toronto, just off Kingston Road. She bought the house in 2019 for $820,000. Her mortgage is $690,000. In the summer of 2021, with mortgage payments increasing and savings depleted, Jennifer started listing her entire home on Airbnb during the 8 weeks she travels every summer. $350 per night, 40 to 50 bookings each summer, between $14,000 and $17,000 in Airbnb income per year. She reported it on her taxes mostly, though she has not always been precise about which form to use or which expenses qualify. She has done this every summer since 2021. She plans to do it again this summer. She has never once considered the possibility that doing so was quietly dismantling the tax protection on the largest asset she owns. What Jennifer does not know is that Airbnb reported every dollar of her earnings, her social insurance number, and her property address directly to the Canada Revenue Agency in January of 2025, covering the 2024 tax year. This is not speculation. This is not a prediction about what might happen in the future. As of 2025, Airbnb, VRBO, and all major short-term rental platforms operating in Canada are legally required under international tax transparency rules to report gross earnings, tax identification numbers, and property addresses for all Canadian hosts directly to the CRA by January 31st of each year. The file that Airbnb sent to the CRA about Jennifer contains 4 years of earnings history. It contains the dates of every booking. It contains the address of the property listed. It contains the number of nights rented in each calendar year. It contains everything the CRA needs to build a complete picture of how Jennifer's home was used between 2021 and 2024. The CRA already has this information. It had it before Jennifer opened that letter. It had it before she started dreading the meeting with her accountant. The compliance review is not a fishing expedition. It is the beginning of a process that starts with data the government already possesses and works backward to find the gap between what was reported and what was earned. And that gap, in Jennifer's case, is large enough to trigger consequences she has never been warned about. The first consequence Jennifer is about to face is the change in use deemed disposition under Section 45 of the Income Tax Act. This is the mechanism that most short-term rental hosts have never heard of and that has the potential to permanently compromise the principal residence exemption protecting their largest asset. Here is precisely how it works. When you acquire a property as your principal residence and then begin using some or all of it to earn rental income, you have triggered a change in use under the tax code. The Canada Revenue Agency treats this change in use as a deemed disposition of the portion of the property converted to income-producing use. The CRA treats you as though you sold that portion of your home on the day you first rented it out and immediately repurchased it at fair market value on the same day. The capital gain from your original purchase price to that fair market value on the date of the change in use becomes potentially taxable, and from that point forward, the principal residence exemption is partially or fully compromised for the period of rental use. Jennifer bought her home in 2019 for $820,000. Then she started renting the entire property on Airbnb in the summer of 2021. By 2021, the fair market value of her home was approximately $1.1 million. The deemed disposition at the change in use date creates a deemed capital gain of $280,000 that is no longer sheltered by the principal residence exemption for the years she rented the entire property. The CRA's position, outlined in Income Tax Folio S 1-F 3-C2, is clear. When a taxpayer rents out their entire principal residence on a recurring basis and is not personally occupying the property during the rental period, the change in use provisions of Section 45(1) apply. Jennifer can elect under Section 45(2) to defer this deemed disposition, but that election must have been filed with her tax return for the year the change in use first occurred. But Jennifer has never filed that election. She did not know it existed. The window to address it retroactively is extremely narrow, and the outcome is not guaranteed. An accountant may be able to help her file a late election in limited circumstances, but the CRA has full discretion to accept or deny that request. Jennifer is not in a position of strength here. She is in a position of hoping the CRA decides to be generous with a taxpayer who did not follow the rules, even if she did not know the rules existed. The second consequence is the proportional denial of the principal residence exemption when she eventually sells. Even if Jennifer does not trigger the full change in use deemed disposition, the CRA's proportional analysis applies to her sale. When she sells her home, and the CRA will examine the number of years she can designate the property as her principal residence versus the number of years she used it to generate commercial rental income. The principal residence exemption formula is precise. 1 plus the number of years of principal residence designation divided by the total number of years of ownership. If Jennifer sells in 2028 after 9 years of ownership and the CRA determines that during 3 of those years the property was being used commercially on a recurring basis, the exemption is reduced by exactly that proportion. The capital gain attributable to those rental years is fully taxable. On a property that has appreciated from $820,000 to $1.4 million, the unprotected capital gain could exceed $200,000. The tax liability on that amount at Ontario's combined marginal rates could reach $100,000 or more, arriving on closing day of what Jennifer believed was a completely tax-free transaction. The real estate agent who listed the property did not warn her. The mortgage broker who helped her refinance did not warn her. The bank that holds her mortgage did not warn her. Nobody in the transaction ecosystem told Jennifer that the 8 weeks of Airbnb income she earned every summer was quietly eroding the protection on $600,000 of unrealized capital gain. The third consequence is the most immediate and the most financially brutal for anyone who operated without full municipal compliance. Under Section 67.7 of the Income Tax Act, which came into full effect for the 2025 tax year with no remaining transitional relief, the CRA now denies all expense deductions for short-term rental income if the property was operated in non-compliance with municipal or provincial licensing requirements during any part of the year. In Toronto, hosts must be registered with the city, and only principal residences are eligible for short-term rental listings. In British Columbia, all listings must be registered in the Provincial Short-Term Rental Registry that launched in May 2025. If Jennifer earned $25,000 in Airbnb income and incurred $12,000 in eligible operating expenses, but did not hold a valid city registration for any portion of the year, the CRA denies all $12,000 in expense deductions. And Jennifer is assessed on the full $25,000 of gross income. At her marginal rate, that single denial costs her an additional $5,000 in taxes. Every year she operated without proper compliance. Documentation is now open to reassessment under the same rule. 4 years of hosting without a city registration number on file means 4 years of expense deductions at risk. The cumulative tax exposure from that single compliance failure alone could exceed $20,000 before interest and penalties are added. The fourth consequence is the one that has been generating the most alarm among real estate lawyers and tax accountants working in the GTA and the Lower Mainland right now in 2026. It is the GST and HST reclassification on sale. And if the CRA determines that a property was used primarily for short-term commercial rental purposes, it may reclassify the property as commercial real estate at the time of sale. In Ontario, that reclassification triggers 13% HST on the full sale price. On a property selling for $1.2 million, that is $156,000 in harmonized sales tax that neither the seller nor the buyer anticipated or budgeted for. The buyer's mortgage approval does not cover it. The transaction either collapses at the closing table or closes with the seller discovering that $156,000 of their proceeds must be remitted to the CRA before they receive a single dollar. And lawyers handling these transactions are describing the experience as a closing day ambush that destroys months of planning in an afternoon. The seller walks away with a fraction of what they expected. The buyer walks away rattled. The deal that should have been the culmination of years of careful financial planning becomes a financial emergency in the final hours before possession. Now, let us return to Jennifer at 2:17 in the morning, staring at the ceiling with the meeting 6 hours away. The CRA has received 4 years of Airbnb earnings data connected to her social insurance number and her property address. A CRA compliance officer has cross-referenced that data against her filed tax returns. They have identified a discrepancy between gross earnings reported by Airbnb and gross income reported by Jennifer. They have found no record of a Section 45(2) election in any of her filed returns. They have found no municipal registration number associated with her listing for the years 2021 through 2023. They have initiated a compliance review. The letter asking for documentation covering 4 years of rental activity, proof of city registration, and an explanation of the income discrepancy is sitting on Jennifer's kitchen counter. The accountant she is meeting in 6 hours is about to tell her that the tax-free sale she planned for 2028 may no longer be what she assumed it would be. He is going to tell her that the number she needs to pay to resolve her exposure voluntarily is significantly lower than the number the CRA will demand if they complete the review on their own terms. And he is going to tell her that the window for voluntary disclosure, the process that allows taxpayers to come forward proactively and receive penalty relief, is open right now, but will close the moment the CRA formally initiates an audit rather than a review. Jennifer has days, not weeks, to act. The difference between acting now and waiting costs tens of thousands of dollars and potentially her clean credit history. For every person watching this who listed a property on Airbnb or any short-term rental platform at any point between 2019 and 2026, here is what you need to understand without any ambiguity. The CRA has your earnings data. It has your social insurance number. It has your property address. It has the number of nights your property was rented in each calendar year. It received this information directly from the platform you used, and it is cross-referencing it against your filed tax returns right now using automated systems that operate continuously without interruption. The compliance review letter may not have arrived yet, but if your rental activity was substantial, recurring, and not fully reported in compliance with the rules that applied when you operated, the review is either already running in the background or it is a matter of when, not whether. There are specific actions available to you right now if this description fits your situation. Download your complete transaction history from your Airbnb or VRBO host account going back to the first year you listed. Compare it line by line against what you reported on your tax returns for each corresponding year. And any discrepancy is an exposure point that is significantly safer to address through voluntary disclosure before a CRA review identifies it independently. Speak with a tax accountant who specializes in real estate and rental properties about whether a Section 45(2) election can still be filed for the year your rental activity began, and what the cost-benefit calculation looks like given your specific property and rental history. If you are planning to sell your home within the next 2 to 3 years and you have a history of short-term rental activity, do not assume the principal residence exemption will cover your full capital gain. Have a professional calculate your actual exemption entitlement before you list the property. The number may be very different from what you have been assuming for years. And if you earn more than $30,000 in gross rental revenue over any 4 consecutive calendar quarters and never registered for GST and HST, that compliance obligation needs to be addressed through a voluntary disclosure before the CRA's data matching identifies it on their timeline rather than yours. For the Canadians watching this who have never listed on Airbnb and feel untouched by this specific trap, consider what is happening to the properties around you. Hundreds of thousands of homes that functioned as short-term commercial accommodations for several years are now entering the resale market carrying complex and unresolved tax positions that their owners are only beginning to understand. The principal residence exemption disputes attached to these properties are going to affect pricing, transaction timelines, and an available inventory in neighborhoods across every major Canadian city over the next several years. The shadow economy that Airbnb created inside the residential housing market is now being brought fully into the light by mandatory platform reporting and systematic CRA enforcement. That process has already started. It is accelerating, and it will not stop until every dollar earned and every property used commercially has been fully accounted for in the government's records. For the people who were priced out of the market during the pandemic years, for the renters who were displaced when landlords converted long-term rental units into short-term Airbnb listings to chase higher nightly rates, this is the accountability that was always coming. The hosts who extracted premium income from properties that should have been available as long-term housing are now discovering that the tax code attached a price to that decision. It was not visible in the moment. It is very visible now. In our next investigation, we are going to expose the trap waiting for the hundreds of thousands of Canadians who renovated their homes between 2020 and 2023. If you spent $50,000, $80,000, or $100,000 upgrading your kitchen, finishing your basement, or adding a rental suite, and you paid contractors in cash without keeping systematic records, the CRA has a specific mechanism called the Adjusted Cost Base Audit that can deny your renovation costs entirely, inflate your taxable capital gain on sale, and send you a bill for money you spent years ago on an asset you have not yet sold. The scale of exposure in this specific area is larger than most people realize, and the CRA's enforcement activity is accelerating heading into the second half of 2026. Subscribe to Canada Property Watch right now and make sure your notifications are turned on, because that investigation is the one that will change how you look at every receipt from every contractor you have ever paid. And by the time most people find out the hard way, it is already far too late to go back and fix it.